So I thought we'd start today's video a little bit differently. I want to firstly congratulate anyone that's been watching and doing the analysis together for Tesla recently, as the price action and positions that we found definitely showed the way into this good news. But more importantly than that, I want to talk about the next 2 weeks, why they're so important for all of us as investors and traders, and how this earnings season could be shaped by just a few different rotations. So with that all in mind, let's take a look at what's going on in terms of the hottest stocks right now, the highest close on the S&P 500 and whether that can take us into a very good stretch of rally, and of course, the fact that it's not being led by semiconductors. We fully expected all of this, but where are the new rotations starting to occur? Well, as it turns out, it could be reinflation coming back into this market. Let's talk stocks, commodities, and cryptos together. It's great to be back. Let's get into it. Well, welcome back, everybody, to the Daily Show, where we talk about the latest macro data, leading indicators, and of course, the hottest charts together. It's great to have you here, and let's get started by just quickly discussing the rotation flows. As we expected, Tesla improved and continued to do very, very nicely as everyone jumps on board the options bandwagon. And interestingly enough, another laggard, AMD, started to improve, which we've discussed a few times on our live show. I think the most important thing of the last 24 hours, though, were banks were up, and we'll go through more of that about money flows later in today's video. If it's your first time here, remember to subscribe and smash that bell icon if you want to understand more about why markets move, and more importantly, how they're all interlinked together. But let's get into the first story of today, and I want to discuss with all of you, let's talk valuations, because of course everyone goes on about it's overpriced, it's ridiculous, we're in a bubble, all of those things. And it really depends on what you're looking at. If we put it back to some of the highest points we've been over the last 20 plus years, then you would notice that, of course, the dot-com bubble got a lot bigger. Now, this was also what we call a concentrated bubble. So basically, there were just a few stocks that were riding this thing up, Cisco, Intel, etc. back then. And guess what? We're currently in what we think is late cycle AI bubble style market, which basically means that anything that mentions AI, even if it isn't AI, is rising up, and it's becoming possibly too high in terms of valuations. Now, where could this lead us to? Well, they often have a saying that the next bubble is usually bigger than the preceding one. So could we go above 25.2? I think it's distinctly possible, and you might think that's insane, but it's something that you could be looking at in the future. And remember, if you ever get into the 23, 25, 26 forward PEs, don't think this time is different. It will be the same as history. It's just a matter of having that temperament, which is pretty much the most important thing for all of us as investors and traders, to be able to hold off the FOMO at those points. So why is this important? Well, it comes back to standard deviations. And of course, we've talked and argued this many, many times over the years, that when we get back to the 30-year average, it's a perfect time to be looking at buying the dip for investment strategies. And when you start getting into this kind of 21 plus, you want to be starting to say, well, I'm going to be more of maybe a swing trader, day trader, position-based trader that's going to have some type of hard stop loss. And you need to be starting to think about late cycles or peakings of markets. Now, again, is it as high as it was during the 2000s? No, not quite yet. But this is something that I think whenever you get over one standard deviation, you have to start thinking about those things. And of course, having a plan so that you don't get caught when eventually it does do something like this. And it will eventually do that, regardless of what people say. It never changes. So let's talk the next 2 weeks. Okay, the next 2 weeks could be very bullish. If you know your data stats, we've talked about this a few times, basically, it's the best period of the year. Now, with the closes that we just saw, the Qs going to a new all-time high and closing at their highs, that's a pretty good sign. And of course, the S&P 500 getting the highest close that it's had, this points towards possibility of further bullish runs into this earnings season. And yes, the earnings season is only a few weeks away, kicking off with the banks. So of course, we need to be aware of this. And it looks like there's a little bit of hype and euphoria coming in. And of course, we're starting to track in one of the best election years we've seen in quite some time. This chart here from All Star Charts from Grant Hawkridge basically shows you that 2024 is now in almost a peer of its own when it comes to an election year. And it's tracking kind of right with that 1976 narrative. And of course, in both of these cases, we ended up driving a bit higher and then having some pretty serious kind of volatility that started to come through September, October, those types of periods. And actually the 76 one, we ended up going a bit lower and then not recovering till right in the back of the year. So will this become important? Well, I think we'll need to be looking at the term structure, which we'll do in just a few moments. But do remember, when we have a good first half, which is over 10%, that is very bullish for stock markets. And usually the July to December return, as you can see here, is quite positive. In fact, 82.6% of the time, which is a pretty good stat, markets will be up. And they're not going to be up just a little bit. They tend to be up quite a lot, sometimes even giving you another double-digit gain. So could we be going into a pretty extreme time? Yeah, it's very possible, and we need to be watching those price actions. On top of this, Wayne Whaley's also came out with, of course, what he thinks might happen over the next couple of weeks, being the hottest period of the year into kind of that July 18th. And as you can see here, he believes that it's 17 up, 1 down. So realistically, now that the market's held again 54.50, which we'll look at in just a moment in our analysis, this becomes very important. This is exactly what we would expect to see if the market wants to hold for now. Now, some things to keep in mind. Will we get volatility on the horizon? Yes. Why? Well, we haven't actually seen a 1% decline or a 2% decline or a 3% decline in quite some time. And we're starting to rise up there now with the amount of days. And as we mentioned, it may have happened possibly on Tuesday, but the markets were not able to close below the 54.50. So this becomes, okay, we keep these stats in our mind and we know that volatility will eventually come back. Now, why is this? Because as I mentioned, term structure is something that's going to drive us higher. We know that in pretty much every election year, we get volatility. Volatility tends to be more in recent times than it was in the past. Why? Well, it's closely contested. And on top of that, there's a lot of uncertainty coming into it, which means that we might get vol earlier. Maybe it's going to be August, maybe it's going to be September and October, but you can see the volume structure starts a lot earlier this year. And it tends to have me thinking that maybe we'll go into earnings positively based on what we're seeing right now. Then we might see some vol coming off those earnings season. And straight after that, things might get serious. Now, where does the market go from here then? What about the breadth? What about the problems that we're seeing when it comes to rotation? Well, I've got some good signs for the breadth side, and a lot of it actually comes back to the global manufacturing PMIs. So we all know that monetary conditions are nowhere near as tight as they've been claiming. They've been actually improving now for the last 1.5 years. On top of this, we also know that global manufacturing PMI has also been improving. Now, it turns out that there is a strong correlation here from top-down charts' chart here that shows you global manufacturing PMI and possibly commodities actually tend to link together, and that makes sense. So what we're actually seeing here is maybe an uptick coming back into one of our favorite trades. And as I mentioned at the start of today's video, it could be we're going back around 3 months to remember when we started to see copper starting to improve, and price action has made drastic changes over the last kind of 3 to 4 days. Big moves in the iron ore market, big moves in copper, all of these things are starting to really show that the reinflation trade actually might be what's happening right now. Big four indicators, as we brought up in our last video, again, it kind of shows you that at the moment, the market's not as sick as maybe people think, and it's still doing okay. And of course, in terms of secular bull runs, if you've been following our analysis here, you would know that we believe that we're kind of in that late cycle. So this is where you're going to get a bubble, which we're already in, an AI bubble. That bubble will become incredibly euphoric. No one will think it can even drop. And then, of course, the problem with the concentrated market is, just remember, if you get stuck in the concentrated market stocks, we'll show this in the next video, you'd be surprised how badly they do over the next 10 years. And yes, I just mentioned that, 10 years of potential underperformance if you get this wrong. So it's going to be very important that you follow certain channels, that you sub to this channel if you're interested in this type of stuff, because if you're wrong on your timing and you get stuck in some of these high quality stocks that are just overpriced, it could get really nasty out there. Let me know what your thoughts are, though, in the comments down below. Now, this is a great one from Jury and Trimmer, and it basically says here the CAPE model. And what his projections are is that we'll basically continue to improve here for a bit into somewhere around 2026, maybe 27. And I tend to agree with him. I think that basically the market is starting to price in this kind of forward projection. We've seen this with Goldman Sachs reports, Bank of America reports, and they've all got this really steep growth curve that kind of shows you that they believe that earnings are going to really hold up till 26. And of course, markets price in the future, But as long as the current is living up to expectations, it's when it doesn't live up to their weird projections, that's when you get the crush. So, of course, at this stage, it looks like there could be enough juice to take us even through 2025, though we'll need to be watching that very, very closely. Now, of course, like anything, there's always a bear case, and I want to mention this. And this one here is from Jason Gottfert over on X. And basically, it's an interesting chart. What it says is it's the breadth problem. So the NASDAQ composite, after making a new high, in this case, a 3-year high, with less than 40% of the stocks in up issues. So basically, not many stocks are going up. It's just the biggest tech stocks driving the whole thing. Now, this means a lack of breadth. And in many times, this has actually peaked markets. But we do need to remember when you look at this chart, the most important one is over here. And if we had data going back into the 1960s, I would think, because that was another concentrated market, I would think we get a similar reading to this. This concentrated market is unlikely to be over just yet, but we are in what looks like to be a sideways kind of grind up phase. And you can see that's exactly what happened over here. A lot of up, down, and all around. So we're kind of in that grind up phase. We're not in that euphoric last run. Now, if the stats are true, and of course, these two end up being where we're at, then you can see it's pretty negative moving forward. So on the flip side of that, we can also have a look here at the S&P 500 after an all-time high, then a 9-day range with less than 1% drawdown. So basically, the S&P 500 stuck between that 5450 zone and that kind of 5500, 5510 zone, and it just kind of went sideways. Then it started to break out over the last 24 hours. Now, what does this tend to do? Well, it does tend to be near kind of like little temporary highs. And I suggest that it's only temporary. Sometimes it's even in melt-up phases where the markets actually overall still end up being bullish, especially 6 months, 12 months later. But it's interesting nonetheless. This is not a bear sign. It's just a kind of sign of, the markets are finding their rotation is what I think they're doing. Now, a few things they're rotating into. We've talked about oil. It's been an amazing runner. Again, congratulations to anyone that's been in the oil trade. We've seen some really nice moves here as basically hedge funds went super bearish and got slogged over the last 2 weeks. And now everyone's starting to talk about it again. And of course, we've already seen probably at least maybe 2/3 of the move go through. Global central banks also, I believe, are starting to purchase gold again. So gold's going to come into focus, and we'll look at that in the charts just a few moments. So we'll check that out in just a minute. All right, let's move over now to the rotations. And as we kind of expected, if we look at the last 5 days, all the things we've been talking about are up the top. Semiconductors been underperforming, which we expected. And of course, regional banks, metals, consumer discretionary, financials. And what I would like to see, and isn't here yet, is the energy stocks. So they're surprisingly behind. But basically, all of these metal plays, the reinflation plays, and the American consumer, which we saw now about 2 weeks ago, start to come up, that's really been improving in recent times. And it suggests that everybody's spending all of their money on credit. And basically, debt production, so debt creation in this case, is starting to increase and allowing Americans, allowing people in the Western world in particular, to borrow more, to take out more credit, and to keep the lavish lifestyles that we got used to during COVID in terms of just, oh, well, I'm going to buy this. Who cares about it? That's exactly what this is kind of telling me. And you know what else is telling me that? The banks, guys. If the banks are doing well, why is that? They're making huge clips. So they're obviously doing quite nicely. All right, let's jump into the charts here and we'll have a look at the S&P 500 and you'll notice it has a pretty strong close on it. And this does suggest that maybe that is not the trap that we thought it could be. And this is why, and I think it's really important that we always do this, we look at the analysis together. So as we know, 54.40, 54.50 was incredibly important. If the market had closed below that, guess what we're going to do? We're going to move down, in my opinion, at minimum to 53.50. Now, it didn't happen. The last 24 hours, the market ended up bouncing back up and ended up quite strong. Now, this is not above these highs, but it does suggest that the markets probably want to start melting up further, as in very slowly kind of melting up. And you know what they say, you shouldn't really be shorting a dull market. So there's two nasty kind of signs here. There's this one here and this one here. And in this case, at this stage, we just haven't gone bearish. It's still a series of higher highs and higher lows. And that's why on the weekend we warned against going short in the market until it went underneath here. Now, if it did, Would that be a huge sign? Absolutely. But as we always say, patience, react, don't predict. In this case, things were certainly looking negative, but they didn't end up eventuating down to that level. Now let's have a look here at the futures market, and you'll see it's the same thing. Every time we came to 54.50, what did we do? We saw bounces, 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 and more bounces. Basically, the market could not get underneath that zone, and that led us into the market moving up to the 5,500 level. And that's where we find ourselves right now. We basically find ourselves where it looks like the market wants to go bullish, even though in many cases, other than the stats of the year, you would think, well, it's overdue for possibly a sell. And we've been talking about a lot of transactions going through. We've been talking about exhausted markets. Obviously, we've got our stop sign here on one of my indicators. And that does tend to lead into, as you can see, pullbacks in markets. You don't get it very often. Like here's one over here. But what you might notice is a lot of the time we'll get this stop sign, then it will go up for like 2 weeks. Funnily enough, you know what 2 weeks we're talking about. Then it will see the pullback. Then it will go up again. So yeah, I mean, I think that with anything, anytime you ever see, look at this, 2 weeks, you can kind of see here, this one ended up happening, but it was very small. And again, we just got the signal. So maybe we're going to go up for a little bit here as the market is trying to strengthen. Of course, if the weekly is able to close above 5,500, that's a very bullish sign. Let's have a look at the options and have a look at whether that makes sense. And we've got the update here for the 3rd. And you can see that there are tons of puts now at 54.65, tons of puts sitting around the 5,500 as well. And that's kind of holding the market into more of the bullish side. Now, we were in a negative gamma situation over the last 24 hours. I'm telling you, if it closed below 54.50, it could have created what we call a waterfall effect. But that's exactly not what happened. It just didn't happen. So at this stage, you would think if the market could actually just flatline onto 5,500 into July 4th, that would be probably pretty normal by this market standard. If the market does go through 5,500 and keep holding up though, slight amount of positive kind of options moving through there. But I would say it's kind of neutralized here in terms of where we are at this stage. And we're sitting right on the neutral point at around that 5,500 level. Let's move over to whether the CTAs are giving us any information. We'll start off here with copper. Again, we're seeing the metals market starting to pick up. NASDAQ, I would say, is up neutral. S&P 500 is neutral, so no CTA movement there. Brent, as we reported in the last video, was super up. So that helped us to, of course, really confirm that oil trade. And gold also saw an uptick after selling off pretty aggressively over the last couple of weeks. So is that a good sign? Well, it shows us that there could be a pickup in metals and rotation through those at the moment. Let's move over to Tesla. Now, Tesla, a positive gamma experience that has been doing very, very nicely. We knew that as soon as we cleared 205, it was going to get ballistic. And of course, as it always happens, what happened? Everyone on X, on Reddit, on probably YouTube and everywhere else starts to get on board that type of thing, and they get hyperactive. It's basically a gamble after that point, and they start pushing in huge into the calls, which is leading to, of course, markets to go higher and higher and higher. Now, it's possible that we can still get to a 250 line, and that would be pretty wild, but you will notice that over the next couple of weeks, we've got a lot of 220s. What's clear is we're in positive gamma, and as long as the hype train can continue and as long as people start piling into calls, the market is most likely going to have to hedge them. So we'll look at that in a moment. What about the signs for Nvidia then? Well, Nvidia is a little bit different. We moved into negative gamma the other day. We obviously know that we're kind of stuck between a 115, 120 zone and 125, and that's exactly where the market sits. It sits around that 123 area. So we basically expect Nvidia to remain kind of trapped for a little bit, maybe even move towards the downside. And if it does start to move up again, probably to cap out at around 130. And why is this? Well, we'll look at the chart again in just a moment. But basically, we expect Nvidia to be in a holding pattern as semiconductors led us here. Now we're seeing big tech stocks start to rotate. And then we're probably going to see things like metals, reinflation trades, and consumer discretionary come through. So let's go through the options market first. And bonds, no real signs of incredible weakness there. US 2-year yield obviously did uptick a little bit, and the 10-year yield ended up at 4.43. What I thought was most interesting, though, is if you have a look at this, remember, uninversion of the yield is the most terrifying thing for the bulls because that's when you should be terrified. And that actually started dropping off since last week. So basically, we're getting closer to the uninversion. And as we know, somewhere underneath here. If we uninvert, the longer we uninvert for and don't get a crash, the bigger the chance of a black swan starting to occur. So if we're sitting there 6 to 12 months later after an inversion and everyone says, oh, it's broken, heavily unlikely it's broken. At that point, you are probably wanting to be terrified in the market, especially if we're valuing ourselves at 24, 25 times forward PE. What about the bond indicator that I have here in terms of overall risk? You can see still trapped within. A little bit of an uptick over the last couple of sessions, so no real signs there of significant weakness. Consumer discretionary versus staples. This is a really good sign for the markets. It's showing that people are probably spending on debt, but at the same time, it's been an uptick. The market is not defensive. If it was defensive, you would see staples outperforming utilities, consumer discretionary. So it's just not happening at this point. Regional banks also started to improve. Of course, banks started to improve. Again, that's a good sign. Remember, when banks are getting terrifying, definitely a warning period, especially for position and investors. Let's move over to copper. So copper came and it touched the 20 moving average, which we know is the most important, rejected it a little bit, but it's really showing signs of improvement. I think people that are looking at metals would start to be getting more excited about this market. In fact, if we have a look at iron ore here, and we'll just load up an iron ore futures contract, you might notice that looks like a damn good chart. Yes, iron ore looks a lot better right now than it has for months and months and months. And funnily enough, it's all kind of happening at the same time that we're seeing a lot of metals starting to improve across the board. And yeah, everyone hates them. So again, price action is dictating the way, just like it did when we pulled out this level down here for position-based investors together, as for Brent and US oil. And of course, US oil traders, congratulations if you went for 84 a barrel. Very nice, good little TP zone for a trader. This particular area here and this particular area here were both highly statistically likely. So if you want to do your analysis, you want to kind of imprint this one into the back of your memory, I would highly suggest you do imprint it into your memory. This is a repeatable pattern that you can constantly use and understand markets a lot better. If you actually break down the storyline here along with Tesla, which we'll be doing in a sec, then these two, very repeatable. And that's what you want to be doing. You want to have the patience to replicate your systems. And if you're ever interested in more of these types of things, I'd highly suggest you check out our day trading masterclass, or of course our advanced masterclass, to figure out how we kind of broke down Tesla a bit better and how you can also start to do that and create replicable strategies. Let's move over to energy stocks. So we saw US oil hit 84 a barrel. Obviously, we've got that next take profit level with the horizontal line, and it's still in an upward trend for now. Now, energy stocks, a little bit more disappointing, frankly. Yes, we've kind of ground out around the same level, but notice it keeps gapping up and then coming back down by the end of the day. 1, 2, 3, 4, 5. That is strange. A lot of red days. So it would be nice to see a green day come out of energy, and certainly something that I'm looking at. And I keep mentioning utilities because I did want to put it on the chart. So let's have a quick look at utilities funds, and they're dropping down as well. They're not quite at my alert level here. I've got 66.80. But I'll let you guys know if it comes back to that level. So energy stocks, oil stocks, pretty good, decent breakout. Certainly, I think a little bit undervalued at this point. Let's move over to gold. Now, gold has found the nothing land between the buy level here of a position-based trader and the most traded level. And really, the only thing you can look at with gold is you can go in here, and I'm sure a lot of you, if you pause the video here, what pattern do you see on this chart? And I'm sure a lot of you will probably mention, yeah, it looks like an inverse head and shoulders. Yeah, I think a breakout from this point could be a good temporary, or at least little sign of bullish action. You can see here it's absolutely consolidating. Is it an accumulation? Kind of looks like one, but it could also be a distribution to the downside. At this point, we're waiting for the next break for gold. So gold looking better than it has, silver looking a little bit better. I'm still not absolutely won over them, but CTAs have been improving, and so have gold stocks. Let's move over to Tesla now. Congrats again to anyone that's been on this huge run. You have to expect it with Tesla. When the hype gets real, everyone jumps in. And of course, with some good news stories, that always helps it. But remember, it never started with the news. It actually started down here at around 176, 178, where we saw price action dictate that it was probably going to go bullish. And at that same time, we also got a huge volume trade, which was just so happened to be a massive dark pool trade. And funnily enough, I'm sure that's some smart person in Wall Street getting that dark pool trade in, and then they've, of course, been able to profit quite massively off this. Now, we did fill into some gaps, though I do see a lot of people mentioning the gap fill. To me, it has to actually fill the gap, not just fill the bottom of the candle wick. But here are some gap levels and, of course, a highly traded zone up here at 250. So I think 250 is an interesting level. 230, kind of in the middle of nowhere now, managed to snap off that downward trend. Huge close, suggests that pullback should be met by bull demand, and this thing's on fire right now. So looking towards possibly more strength here in the Tesla trade. And then I'm sure as it crescendos into these levels and everyone thinks it's going to like $5,000 or whatever, it will probably have a big pullback. But at this stage, it does seem to be bullish still. Nvidia, on the other hand, as we said, trapped between the 120 and the 130 zone, and that's what we expect. We expect this market to be weaker because, of course, semiconductors versus SPY have weakened because it just ran too fast. And this is what always happens. It consolidates for a period, and ideally, this consolidation would also bring some weakness with it. We would come back to the weekly 20, and that would give a pretty good entry point for all of us as investors and traders because, of course, this is the strongest market in the world right now. And although it might be taking a bit of a breather and hitting the daily 20, which you can see here, there's not really any sign of incredible strength or anything like that coming out just yet. All right, let's move over to the other market sector that seems to be doing well, which is metals. And metals have started to uptick. This is metals versus SPY, or materials versus SPY. And you can see here that we're seeing an uptick in this, and it's happening at around that same level we previously saw it. And again, starting to improve across the board. So yeah, it's an interesting sector and it's starting to do a bit better. Another one that did better over the last 24 hours is the Chinese market. Saw Alibaba do a buyback. Again, they just keep accelerating buybacks. It doesn't work as well as it does in the US. And that just shows you how powerful it is. Buybacks are powerful, but really it's sentiment. Fear and greed are the two most powerful concepts. And if everyone doesn't believe in Baba, it doesn't matter. The buybacks aren't having a massive effect on them. It just kind of says, well, you've got nothing better to do with your money and we're scared of this business. So anyway, 10-cent improvement. Obviously want to see this start to rise up. We also see HSI improvement. And again, still bullish on this from position-based investment, but there's no signs for a swing trader yet. Swing traders will want to be getting above that 18.6 level and then saying, all right, let's go to a new high here or new 24-month high. Now let's move over to the US market in terms of some other things. The Qs closed at that previous big rejection level. Now a close here is significant. It does usually point towards pullbacks being met by bull demand, a melt-up market. It's a close on the high. So with the 2-week stat, you've got to kind of think the markets are kind of trying to push. And of course, the S&P could be pushing towards 5,600. The US 30, also a decent close, kind of snapping a bit of those dojis, and possibly it's going to start moving up. And the US 2K, well, it's doing nothing. So as I've mentioned many times, unless this thing's above 2,100 and closed, I think it's kind of not the right area to be in just yet. All right, let's move over to the market that is not doing very well, which is Bitcoin. So we saw an uptick on the trader side, which would be from here to here. Thought it might be able to get a little bit higher, maybe 64.5. Of course, certainly not a bull swing yet, which is up here in these highs. But this is not a great sign for Bitcoin. And it could be suggesting that we're going to get either a new swing of a low and then rally, or we might even be going down to the 51.5 zone. So unfortunately for Bitcoin traders, not a great couple of trading sessions here. Obviously the weekly, very strong, being able to get back up here, not too bad, but then it's doing this. So it'll be interesting. I think I'd wait for the weekly close again if I was trying to position invest and wait until this actually makes a decision. Because if this closed underneath here, it's bad, guys. That's really suggesting at minimum this. So I think a very important point, great week here to be watching Bitcoin, non-farm payrolls, of course, as well. And as we know, the news is still coming. We have a few things, the FOMC meeting minutes, we have the PMI, ISM PMI, and then, of course, we've got July 4th. Happy July 4th to everyone in America. And, of course, then we've got Friday non-farm payrolls. So this one will be the important figure. And although we know it's usually wrong and completely BS, what we always do here is we look at the revisions. So have they revised all of the jobs again? What does that mean for us? We'll be breaking it down together. As always, guys, if you enjoyed today's video, please remember to subscribe. Check out our overall courses if you're interested, or of course, follow us on some of our other socials. And it's great to be back. Thank you so much. And look forward to coming back to you tomorrow with the close leading into For some of you, hopefully a long weekend. Bye.